Let's start this week with revenue recognition. This is the most important area to get right for both firms and their investors. And as you might suspect, accountants think about revenue a little differently than how most of us think about it in our everyday lives. But that's okay, because that's why you're here, to learn how accountants think. Might be a little scary, but good to know. Let's start with a simple example. Assume your firm gets an order for 5 units at $200 apiece in their first quarter, Q1. It takes you a while to finish production, and you end up shipping and delivering the goods in Q2. Since you sell on credit, you send an invoice to your customer, and they pay you in quarter 3. Question is, in which quarter should you recognize revenue? Q1, Q2, or Q3? Under the cash basis, you would wait until Q3, since that's when you get the cash. This is how most of us operate in our daily lives. You don't really feel like you've earned your paycheck until you get it in cash. Am I right? But the accountants look at it a little differently, because they want to show revenue in the period in which the firm did all the work to complete the sale, which is Q2 in this case. Getting the check or cash payment is important, obviously, but doesn't really require any significant effort by the seller. So it is not viewed as a critical factor in determining when the revenue is earned. That's really the basis for accrual accounting. Recognize revenue in the period in which it is earned, when the earnings process is complete. Cash collection can happen at a later date. Let's look at a little more elaborate example. Let's assume that on July 15th, Concord Farms, which is a dairy farm, receives an order for 10,000 gallons of milk. Price is $2 a gallon. The milk won't be delivered until sometime in August. So what do? Even though this is clearly an important order for Concord Farms, the accountants don't do anything at this point. No entry is made because nothing has been exchanged other than promises. Something more tangible must be exchanged, like cash or the product, before the accountants will make a formal journal entry. Concord Farms can still let their investors know that they have received such an order and any other backlog of orders that are not yet filled. It's just that no formal entry is made at this point. By August 10th, the milk is ready, bottled up, and delivered to the grocery store. As is customary in many businesses, Concord delivers an invoice along with the milk and requests payment within a few days or weeks. At this point, since payment can be reasonably expected to happen, the earnings process is complete, and Concord can go ahead and recognize revenue with a journal entry. And the journal entry looks like this. First, record $20,000 as revenue. This will cause an increase in net income, which in turn increases retained earnings. However, our balance sheet equation is not in balance yet. While we would normally want to increase cash by $20,000, we can't because we don't have the cash yet. But since the customer is now obligated to pay us, we can record this obligation as an account receivable, which just represents money owed to us by our customers. And this puts our balance sheet in balance. Assets equal liabilities plus stockholders' equity. Then, a few days later on August 20th, when the customer pays their bill, Concord records an increase in cash and a decrease in accounts receivable, since the obligation from the customer has now been paid. So you should note here that the revenue was recognized when the milk was delivered, not when cash was received. This is the heart of accrual basis accounting. When cash is eventually received, it's merely an exchange of one asset, cash, for another asset, accounts receivable. Well, since this is so much fun, let's look at another example. Let's look at the situation where your customer pays you up front before you've delivered your product or service. Usually, this is in the form of an advance payment the customer makes to ensure good service or guarantee delivery. Here we assume a new customer submits an order for $10,000 of milk and makes a $2,500 down payment. Notice the difference between this and the previous example, where the customer submitted an order with no advance payment. In that case, we didn't make any entry. But here, since something more tangible has been exchanged, we can account for that part of the transaction. Concord received $2,500 in cash, so we must record an increase in cash of that amount. But we can't recognize this as revenue yet because Concord has not completed the earnings process by delivering the milk. So what do? Can't leave it like this. We're not in balance. And no accountant worth their salt can go home for the day until all the accounts are in balance. It's just not done. The solution is to understand that by receiving the $2,500 down payment, Concord now has an obligation to complete the sale to the customer. This obligation is a liability, and we call it unearned revenue, or sometimes deferred revenue. Then, when Concord delivers the milk and completes the earnings process, they can recognize the full $10,000 of revenue, which, as before, we see increases net income and retained earnings. Since the sale has been completed, Concord no longer has a $2,500 liability, so this can be decreased, and the customer still owes Concord $7,500 for the rest of the sales price, which we record as an increase to accounts receivable. And finally, when the customer pays their bill, we increase cash and decrease accounts receivable for the $7,500. Key things to remember. Under the accrual basis, revenue is recognized when the earnings process is complete, usually when the product or service has been delivered, and not based on when the cash is received. This means that revenues do not always equal cash flow. And we will see the same thing with expenses, which should lead you to realize that if revenues don't equal cash received and expenses don't equal cash paid, well, then net income is not going to match cash flow, which is what ultimately leads to the need for the third statement, the statement of cash flows, which we will look at a bit later.